As with any personal investment portfolio, your self-invested personal pension should be diversified across sectors and geographies to limit risk. It's great having growth in your portfolio, but you'll want to preserve that capital too.
If you're starting your Sipp from scratch, it may well be that you're not quite ready yet for direct equity investment, in which case some of the ways to get to that diversification might be via funds, either exchange-traded funds, ETFs, or indeed managed funds where you're entrusting your money to a professional fund manager.
The asset types in your portfolio are unlikely to change very much through the life of your pension. Equities will feature heavily, so will fixed income. Alternative assets like gold and property will too. Investment trusts offer a great way into these alternative assets and with better liquidity.
Your pension pot, very much a long-term investment. What you'll probably also find is that you've got a different attitude to risk depending on your age. In your 20s, for example, you've obviously got a good 40 years worth of investment to consider, so you can probably consider higher risk. As you get nearer to retirement age and you want more preservation of your capital, you may well find that your risk appetite lessens.
Don't forget AIM shares, which have been eligible for SIPPs for 5 years now. Whether it's individual stocks or funds, returns from this high growth market can really supercharge returns. But don't bet the farm on one stock. This is a high risk market, especially if you're investing in individual stocks.
Generally speaking, investors fall into two camps, growth investors and income investors. Usually that's dependent on your age. As you get nearer to or even post-retirement age, you're likely to be an income investor, where the income from your shares is your main concern. Earlier on in your investing career, however, you're more than likely to be looking for capital growth, and that's why you'll be a growth investor.
International shares are becoming more popular among SIPP investors. They offer valuable diversification and access to sectors like technology that are underrepresented in the UK market.
Bearing in mind this is your pension pot and this is a long-term investment, there might be a slightly different mindset. It's not a trading account, it's an investment portfolio. Trading can easily be done through the likes of an ISA, for example. SIPP, generally speaking, you're going to be talking about the long term, much more of an investment portfolio.
Most SIPP assets will be long-term investments, but don't be fooled into thinking this is a buy and hold forever portfolio. Sure, you'll want to tinker as little as possible, but even long-term holdings will need trimming and underperformers weeded out.
One of the wonderful things about investing is something called compound interest, something that Einstein referred to as the eighth wonder of the world. It can be extremely powerful over time. For example, a grandparent putting aside £5,000 and earning 10% per year means that the grandchild, by their retirement age, is looking at a capital pot of £1 million. In terms of interest, the shares equivalent is reinvesting your dividend.